It was a normal Tuesday evening in a quiet suburb outside Dallas, the kind of place where every house looks perfect from the outside. Clean lawns, two-car garages, porch lights glowing warm at sunset. And inside one of those houses was a guy named Jake, sitting alone at his kitchen counter, staring at his phone. Just 6 months ago, this exact moment would have felt like success. He remembered the day he got the keys, the handshake, the
Congratulations on
smile
your
from
new
the real
home.
estate agent, the photo he posted online with the caption, "Hard work pays off." Hundreds of likes, comments saying, "Proud of you. You made it. This is the dream." And for a moment, it really felt like it. Because in America, owning a home isn't just about having a place to live. It's emotional. It's identity. It's proof that you're doing something right in life. From childhood, people are programmed to believe that renting is throwing money away and buying a house is the smartest financial move you can make. So when Jake got approved for his mortgage, he didn't
Yes.
question it. He didn't slow down.
finally
He didn't ask himself whether this was actually comfortable for his life. The only thing running through his mind was that he finally reached the level everyone talks about. But now, 6 months later, reality was starting to feel different. That notification on his phone wasn't just a reminder, it felt like pressure. Mortgage payment due in 3 days, $2,487. Then another notification, credit card payment, $320. Car loan, $540. Insurance, utilities, groceries, gas, subscriptions. It all stacked up fast. And the strange part was, Jake wasn't broke. On paper, he was doing fine. He had a stable job, making around $80,000 a year. He had a house worth almost $400,000. If you looked at his life from the outside, everything looked solid. But inside, there was a constant weight sitting on his chest, because every dollar now had a destination before it even hit his bank account. And that's where most new homeowners make the mistake. It's not that they buy a bad house. It's not that they get scammed or make some obvious financial error. The real mistake is much quieter. It's psychological. It's the decision to stretch themselves to the maximum limit just because the bank said they could afford it. Because when Jake got approved, the number felt like opportunity. $400,000. It sounded like freedom. But what it actually was the bank calculating the highest possible amount he could handle without collapsing immediately. Banks don't approve you based on what makes your life easy. They approve you based on what keeps them safe. There's a huge difference. Jake didn't realize that he wasn't choosing a house. He was choosing a monthly obligation that would follow him every single day for the next 30 years. And once you're inside that system, everything changes. The way you think, the way you spend, even the way you make decisions about your future. Because now, you don't just live your life, you manage your payments. At first, it didn't feel like a problem. The first month was exciting. Setting up the living room, buying furniture, inviting friends over. There's this emotional high that comes with owning something big. It feels like progress. It feels like growth. But that high fades fast, and what replaces it is routine. And routine is where the truth shows up. Every month, the same number leaves your account. No matter how you feel, no matter what happens in your life, that payment is waiting. And slowly, without realizing it, Jake started adjusting his life around that number. He stopped eating out as much, not because he wanted to save money for something meaningful, but because he had to make sure everything else was covered. He delayed fixing small issues in his car. He started checking his bank balance more often than before, not out of curiosity, but out of concern. And the most important shift was invisible. He stopped feeling relaxed about money. Even though he was earning the same, even though his income didn't change, his mental state did, because now there was no margin for error. This is something nobody talks about when they tell you to buy a house. They don't talk about the pressure of consistency, the pressure of knowing that one unexpected expense can throw everything off. A medical bill, a job change, a market shift, anything. When you're stretched too thin, small problems feel like big threats, And that's exactly what was happening to Jake, not because he made a stupid decision, but because he made a common one. In the U.S., most people don't ask how much house they should buy. They ask how much they can get approved for. And that question alone changes everything, because approval is not the same as affordability. Approval is a maximum limit. Affordability is about comfort, flexibility, and peace of mind. Jake chose the maximum, and at the time, it felt like he was leveling up. But in reality, he was locking himself into a system where every month would demand performance from him. There's also another layer to this that most people don't notice: social validation. When Jake bought his house, people around him treated him differently. Family members were proud. Friends respected him more. On social media, he looked like someone who had figured things out. And that validation creates a dangerous loop, because once you step into that identity, you feel like you have to maintain it. You can't go backwards. You can't downsize. You can't admit that maybe you pushed too far. So instead of adjusting, most people double down. They keep going, even when it starts to feel uncomfortable. And psychologically, this creates stress that builds slowly over time. It doesn't hit all at once. It's not dramatic. It's quiet. It shows up in small decisions: saying no to things you used to enjoy, thinking twice before spending even a small amount, feeling a slight tension every time a bill comes in. It's not enough to break you, but it's enough to change how you experience your daily life, and that's the real cost. Jake started noticing it during moments that had nothing to do with money: sitting in his living room, watching TV, but not fully relaxed, going to bed, but thinking about next month's expenses, waking up, already calculating what needs to be paid. It's like his house, which was supposed to give him stability, started controlling his attention. And that's when the realization slowly began forming in the back of his mind. Maybe this wasn't freedom. Maybe this was just a different kind of pressure. And the truth is, this happens to thousands of people every year. First-time homeowners who follow the exact same path: good income, strong approval, big purchase, and then a slow shift into financial tightness. Not because they're irresponsible, but because they misunderstand what they're actually signing up for. A house is not just a one-time decision. It's a long-term commitment that affects every part of your financial behavior. Jake thought he was stepping into a better life, and in some ways he was. But what he didn't realize is that he also stepped into a system that required him to be perfect every single month. No mistakes, no surprises, no breaks. And life doesn't work like that. That's the beginning of the mistake. Not the house itself, but the way people approach it. The belief that bigger means better. The assumption that approval means safety. The idea that owning automatically equals winning. All of it sounds good in theory, but in real life, it plays out very differently. And Jake was just starting to see that difference.
The shift didn't happen overnight. It was slow, almost invisible at first, like something changing in the background of Jake's life while everything on the surface still looked normal. From the outside, nothing was wrong. He still had the same house, the same job, the same routines. But internally, things felt tighter. Every decision now had a calculation behind it. Before buying the house, money felt like something he managed. After buying it, money started managing him. And that's where the real mistake begins to show itself, not in numbers, but in behavior. Because once you take on a financial obligation that stretches you close to your limit, your entire lifestyle begins to adjust around it, whether you realize it or not. Jake didn't wake up one day and decide to sacrifice his freedom. He slowly traded it, piece by piece, for the idea of stability. At first, he told himself, this is just what adulthood feels like. Responsibilities, bills, structure, that's normal. That's what everyone deals with. But there's a difference between responsibility and restriction. Responsibility gives you structure while still allowing flexibility. Restriction removes flexibility completely. Jake started noticing that he couldn't move the way he used to. Small choices felt heavier. Going out with friends meant checking his balance first. Booking a short trip felt like a risk instead of something normal. Even buying something simple online required a moment of hesitation, not because he didn't have money, but because he knew that money already had a job assigned to it. And this is where the concept becomes real. He became house rich, but life poor. On paper, Jake looked like he was building wealth. He owned a property, he was building equity, his net worth technically increased. But in reality, his day-to-day experience was shrinking. His flexibility was gone, his ability to take risks disappeared, his sense of control over his own life started fading. And the most dangerous part is that this situation feels normal because so many people are living it. When everyone around you is also financially stretched, it stops feeling like a problem and starts feeling like the standard. But normal doesn't mean optimal, it just means common. The psychology behind this is powerful. When people buy a home, they don't just upgrade their living situation, they upgrade their identity. They start seeing themselves differently, more successful, more established, more adult. And with that identity comes pressure to maintain a certain image. Jake didn't just buy a house, he felt like he had to live up to it. The empty rooms didn't feel right, so he filled them. A better couch, a bigger TV, decorations, small upgrades that didn't feel significant individually, but added up quickly. And most of it went on credit, because in his mind it wasn't overspending, it was completing the picture. This is how lifestyle inflation quietly attaches itself to major financial decisions. You don't just buy the house, you buy everything that comes with it. And now, instead of one major payment, Jake had multiple layers of financial pressure. Mortgage, credit cards, utilities, maintenance, subscriptions. It wasn't overwhelming all at once, but it was constant. That's the difference. A single large expense can be planned. Constant smaller expenses create ongoing stress. And over time, that stress starts to change how you think. You become more cautious, more conservative, less willing to take chances. Jake used to think about starting something on the side, maybe a small business, maybe investing more aggressively, but now those ideas felt risky because risk requires a safety net, and his safety net was thin. This is one of the most underrated costs of buying too much house. It doesn't just affect your bank account, it affects your mindset. It makes you prioritize stability over growth. It keeps you locked into situations that might not be ideal, but feel safer than change. Jake started noticing that he was saying no to opportunities without even fully considering them. A friend mentioned a potential business idea. He brushed it off. His company offered a role in another city with higher pay. He didn't pursue it. Moving felt complicated. Selling the house felt like a process he didn't want to deal with. And suddenly, he was anchored, not physically, but financially. And the irony is, the house that was supposed to give him stability was now the reason he felt stuck. That's the contradiction most people don't see when they chase homeownership too early or too aggressively. Stability is only valuable when it doesn't come at the cost of flexibility. If your stability traps you in one position, it's no longer an advantage, it becomes a limitation. Jake began to understand this slowly, through experience, not theory. Another thing that started changing was his relationship with money itself. Before the house, money had multiple purposes. It was for living, enjoying, investing, exploring. After the house, money had one primary role: survival of the system he created. Pay the mortgage, cover the bills, maintain the house. Everything else became secondary. And when money loses its flexibility, life follows. Because money is not just currency, it's options. The more freely you can use it, the more control you have over your life. The more restricted it becomes, the fewer choices you can make. Jake also began to feel something he couldn't quite explain at first, a low-level anxiety that never fully disappeared. It wasn't panic, it wasn't fear. It was just a constant awareness that things needed to stay stable, that nothing could go wrong. And that kind of mental pressure builds over time. It affects how you think, how you sleep, how you plan your future. Because instead of thinking about what you want, you start thinking about what you need to maintain. And this is the point where most homeowners don't admit what's happening, because admitting it would mean acknowledging that the decision they were proud of might not have been as perfect as it seemed. And that's uncomfortable. So instead, they normalize the pressure. They tell themselves this is just how life works, that everyone is dealing with the same thing. And in a way, they're right. Many people are. But that doesn't mean it's the best way to live. Jake wasn't in a crisis. That's important. He wasn't missing payments. He wasn't drowning in debt. He wasn't failing. He was functioning. And that's what makes this mistake so dangerous. It doesn't destroy you immediately. It slowly reshapes your life into something more limited than it could have been. It trades potential for predictability. It replaces freedom with obligation. And the deeper realization was starting to form. He didn't just buy a house, he bought a lifestyle that required constant financial performance. Every month, the same expectation, no breaks, no flexibility, no room to experiment. And the more he thought about it, the more he started questioning something that once felt obvious. Is this really what success is supposed to feel like? Because if success comes with constant pressure, limited choices, and a mindset focused on maintaining instead of growing, then maybe the definition itself needs to be re-examined. Jake was beginning to see that the biggest mistake wasn't the purchase itself, it was the way he approached it, the assumption that bigger was better, that approval meant safety, that ownership automatically meant progress. All of those ideas felt true at the beginning, but now, living inside the reality of it, they didn't feel as solid. And this is where most people reach a turning point, whether they admit it or not. They either continue pushing forward, accepting the pressure as normal, or they start questioning the system they've stepped into. Jake hadn't made any drastic changes yet. He hadn't sold the house or completely restructured his finances, but mentally something was shifting. The way he looked at money, the way he defined success, the way he thought about freedom. And that shift is the beginning of awareness. Because once you see the pattern, you can't unsee it. And once you understand that being house rich and life poor is a real trade-off, you start looking at every financial decision differently, not just based on what you can afford, but based on what it will cost you in terms of flexibility, peace, and control over your own life. And Jake was just starting to realize that the real cost of his house wasn't the monthly payment, it was everything that came with it.
After a few more months passed, Jake stopped thinking of his situation as temporary. At the beginning, he told himself he just needed time to adjust, that once he got used to the payments and built a routine, everything would feel easier. But instead of things getting lighter, they started stacking, not in a dramatic way, not in a way that would scare him instantly, but in a slow, consistent buildup that never really gave him a break. And that's when the hidden side of homeownership began to show itself, the part nobody includes in the excitement, the part that doesn't show up in mortgage calculators or real estate listings. It started with something small, a leaking faucet in the kitchen. It didn't seem like a big deal, just a minor inconvenience. He thought he would fix it over the weekend. But then the weekend came, and instead of fixing it himself, he called someone. $200 gone. A week later, the HVAC system started making noise. Another inspection, another few hundred. Then a recommendation that something might need replacement within a year. Suddenly, that small issue wasn't small anymore. And this is how it works. Home ownership doesn't hit you with one massive expense that you can prepare for. It hits you with constant maintenance that you can't fully predict. Every month, something needs attention. Every year, something bigger shows up. And unlike rent, where your cost is fixed, here the ceiling is always open. Jake started realizing that his house wasn't just a payment, it was a system that constantly demanded input, time, money, attention, and the more he gave it, the more it asked for. It wasn't malicious, it wasn't unfair, it was just reality. But it was a reality he hadn't fully understood before stepping into it. People talk about building equity, but they don't talk enough about maintaining the structure that holds that equity. And maintenance isn't optional. You can delay it, you can ignore it for a while, but eventually it catches up, and when it does, it's usually more expensive. At the same time, something else started changing inside him. Before buying the house, Jake was open to uncertainty. He was willing to take chances. The idea of switching jobs, trying something new, even failing and recovering, it all felt manageable. But now, with a fixed obligation sitting over him every month, his tolerance for risk dropped. Not because he became less ambitious, but because the consequences of failure felt heavier. If something went wrong now, it wasn't just about him. It was about keeping the system running, keeping the house paid, the bills covered, everything stable. And that's when he started saying no to things he would have said yes to before. Not consciously, not dramatically, but automatically. A friend invited him to collaborate on a small business idea. He hesitated and then declined. His company hinted at a possible relocation opportunity that could increase his salary, but would require moving and temporary instability. He didn't pursue it. Even simple things like taking a break from work for a few months felt impossible, because now he wasn't just living life, he was maintaining a structure that required consistency. This is where the opportunity cost becomes real. It's not always about the money you lose directly, it's about the options you no longer have. Jake didn't lose money when he said no to that job opportunity, but he lost potential growth. He didn't lose cash when he avoided that business idea, but he lost a chance to create something new. And over time, these missed opportunities add up in ways that are harder to measure, but just as important. Another layer started building on top of everything else, the reliance on credit. Not because Jake was irresponsible, but because the system he was in didn't leave much room for error. When unexpected expenses came up, he didn't always have the liquidity to cover them comfortably. So he used his credit card, telling himself he would pay it off soon. And sometimes he did, but sometimes the balance stayed. And once you start carrying small amounts of debt while already managing a large obligation, things begin to overlap. Interest builds quietly. Minimum payments become part of your monthly routine, and without realizing it, you create a second layer of pressure on top of the first. Now, Jake wasn't just managing his house, he was managing his house plus his debt. And that combination is where things start to feel heavy, because both require consistency, both require discipline, and both reduce your flexibility. The margin for error becomes thinner. A small disruption can create a ripple effect. And even if nothing goes wrong, the constant awareness that something could is enough to keep you on edge. There was a moment, late at night, where everything came together for him. He was sitting in his living room, lights off, just the glow from the TV reflecting on the walls, the same walls he once felt proud of. And for the first time, he didn't feel pride. He felt something closer to responsibility, not in a positive way, but in a weight that never fully goes away. And that's when the thought hit him clearly, without distraction. He didn't own this house the way he imagined. This house owned his decisions. It influenced where he worked, how he spent, what risks he took, even how he thought about the future. And that realization didn't come with panic, it came with clarity. Because once you see it, everything starts making sense. Why he felt more cautious, why he felt less flexible, why even small financial decisions carried more emotional weight. It wasn't just about the numbers, it was about the structure he had stepped into. The truth is, none of this makes home ownership bad. That's not the point. The problem isn't the house itself. It's the way most people enter it without fully understanding the trade-offs. A house can be a powerful asset if it's aligned with your life, but if it stretches you too far too early, it becomes something else, something that limits you instead of supporting you. Jake started looking at his situation differently, not with regret, but with awareness. He realized that the biggest cost wasn't the mortgage, the maintenance, or even the debt. It was the loss of flexibility, the inability to move freely, to make bold decisions, to adapt quickly when opportunities showed up. And in a world where adaptability is one of the most valuable skills, that loss matters.
If this video opened your eyes, make sure you subscribe, because what you learn today can save your future tomorrow.